Have you ever wondered what would happen if everyone tried to pull their money out of the bank at the same time? Or why banks only keep a tiny fraction of your deposits on hand? Today, we're diving into what's really happening with your money, and trust me, it's not what you think. The truth about how banks use your cash might shock you, and by the end of this video, you'll know exactly how to protect yourself. When you put your money in the bank, you probably imagine it sitting there safely in a vault, just waiting for you to come and withdraw it. But that's not exactly how it works. Banks actually operate on something called fractional reserve banking, and this system allows them to loan out most of the money you deposit. In fact, they only keep a small fraction of it on hand. That's right, your money isn't just sitting there waiting for you. It's being used, and that creates some real risks most people never think about. So what's really happening with your money? Let's take a closer look. But before we do that, let me introduce myself. My name is Greg Hardy, and on this channel we talk about all things personal finance, investing, and building a financially secure future. If you're passionate about taking control of your finances and learning something new every week, subscribing is the best way to stay connected. One click helps grow this community and brings this knowledge out to others who need it. Thank you. Guys, the truth is, your money doesn't just sit in a vault collecting dust. Banks use your money. They take your deposits and loan them out for mortgages, business loans, car loans, and even invest in other financial products. This is how banks make their profits. They charge borrowers higher interest rates than the small amount they pay you in interest, and they pocket the difference. But here's where things get a little concerning. Banks operate on a system called fractional reserve banking. This means that they're only required to keep a small portion of your deposits in reserve, just enough cash on hand to handle day-to-day withdrawals. The rest of your money is out there working for the bank, not sitting safely in your account. In the US, reserve requirements used to be around 10%, meaning for every $100 you deposited, the bank only needed to keep $10 available. But in recent years, those requirements have dropped even lower, and in some cases, they're down to 0%. So think about what that really means. If everyone tried to withdraw their money at the same time, the bank simply wouldn't have enough cash to cover it. Most of your money has been loaned out or invested elsewhere. That's why when there's financial panic, like during the Great Depression or even the 2008 financial crisis, we see bank runs. People rushing to pull their money out before it's gone. And sometimes, those who wait too long get stuck without access to their own cash. Even though the system is designed to keep things running smoothly, it's built on the assumption that most people won't withdraw their money all at once. But when fear sets in, that balance can fall apart fast. Just look at more recent events like the collapse of Silicon Valley Bank in 2023. They didn't have enough liquid cash when customers wanted their deposits back, and it led to a total breakdown. The takeaway, your money isn't just sitting there. It's being used, and not necessarily in ways that benefit you directly. Banks prioritize their profits, loaning out as much as they can while keeping just enough on hand to avoid trouble. And when things go wrong, it's the everyday depositor who's often left scrambling. So the next time you see your bank statement and assume your balance is safe and sound, remember, the number you see on the screen is just that, a number. The actual cash behind it, it might be funding someone else's mortgage, financing a business loan, or tied up in investment somewhere. Understanding this is the first step towards protecting your financial future. A bank run is one of the scariest things that can happen in the financial world, and it's exactly why the idea of your money being safe in the bank isn't as simple as it seems. A bank run happens when too many people panic and try to withdraw their money all at once. The problem? Because of fractional reserve banking, most of that money isn't actually sitting in the bank. It's being loaned out or invested, and only a small fraction is kept in reserve. So when demand for cash suddenly spikes, the banks can quickly run out of money. We've seen this play out in some of the most devastating moments in financial history. During the Great Depression, bank runs wiped out people's savings overnight. The fear spread so fast that people lined up around the block just to pull their money out before their bank collapsed. And once the cash reserves dried up, those who didn't move fast enough lost everything. This led to widespread panic and made an already terrible economic situation even worse. More recently, in the 2008 financial crisis, we saw similar risks surface. As big banks faced massive losses on bad loans and risky investments, people started worrying about their deposits. Some banks were pushed to the brink of collapse, and many only survived because of government bailouts. Without that intervention, everyday people could have lost their savings, even money they thought was safely insured. Even in the modern era, bank runs still happen. In 2023, the collapse of Silicon Valley Bank was a perfect example.
from the federal government. Let's look at how we got here. First of all, what is SVB?
Collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
When word got out that the bank was facing liquidity issues, panic spread like wildfire. And within days, billions of dollars were withdrawn, and the bank simply couldn't keep up. Depositors who didn't act fast enough found themselves locked out of their accounts, unsure if they'd ever see their money again. The scary part is how fast it all happens. Bank runs often start with just a little bit of fear, maybe some bad news about the bank's financial health, but as people rush to withdraw their money, that fear becomes a self-fulfilling prophecy. The more people pull out their cash, the more likely the bank is to fail. And once that momentum starts, it's almost impossible to stop. And while bank runs are rare, the damage they cause is massive. The people who hesitate often lose the most. And sometimes even those who move quickly face delays or losses. That's why understanding the risks of fractional reserve banking and knowing how to protect your money is so important. Because when a bank run happens, you don't want to be the last one in line. You might be thinking, isn't my money insured? And yes, it is, but only up to a point. In the U.S., the Federal Deposit Insurance Corporation, or the FDIC, insures deposits up to $250,000 per account per bank. That means if your bank fails, the government steps in to make sure you get your money back, at least up to that limit. For most people, though, that's enough coverage. But if you have more than $250,000 in one bank, anything over that amount isn't protected. But what happens if multiple banks collapse at the same time? FDIC insurance is designed to handle isolated failures, not a widespread financial meltdown. If a major crisis hit and several banks went under at once, the system could get overwhelmed. Even if your money is insured, you could face long delays before getting your funds back. And during a financial crisis, time is everything. You need quick access to your savings, not months of waiting for a payout. There's also the risk of losing buying power while you wait. Even if the FDIC eventually covers your losses, inflation could eat away at the value of your money. If it takes weeks or even months to get your funds back, prices could rise in the meantime, meaning the money you finally recover buys less than it would have when you first needed it. This is especially true during economic instability when inflation often spikes. So while FDIC insurance provides an important safety net, it's not a perfect solution. It won't fully protect large balances, and it doesn't guarantee immediate access to your money either. That's why it's so important to spread your savings across multiple banks, diversify your assets, and have a plan for emergencies. Just because your money is insured doesn't always mean it's truly safe. So how can you make sure your money stays safe no matter what happens? The first smart move is to diversify your savings. Don't keep all your money in one bank. Spread it across different types of accounts like high-yield savings accounts, money market accounts, and even U.S. Treasuries. High-yield savings accounts gives you better interest rates, while money market accounts often offer more flexibility. U.S. Treasuries are one of the safest investments out there because they're backed by the government. By spreading your money around, you lower the risk of losing access to all of your cash if one institution runs into trouble. Next, make sure to keep an emergency fund liquid. This means having money you can get to quickly in case of a financial crisis. A savings account with FDIC insurance is a good start, but you might also consider keeping a small amount of physical cash on hand. If there's ever an issue with banks freezing withdrawals or facing delays, having cash available for immediate expenses can be a lifesaver. Just make sure the amount you keep at home is reasonable and stored securely. It's also a smart move to explore alternative assets. Banks aren't the only place to store and grow your wealth. Consider investing in things like gold, real estate, and index funds. Gold often holds its value during economic downturns. Real estate provides long-term appreciation and passive income opportunities. And index funds let you invest in a broad mix of companies with lower risk. By diversifying into these areas, you protect yourself from banking system failures and inflation while also building wealth for the future. Finally, know your bank's health. Not all banks are created equal, and some take on far more risk than others. Do a little research on your bank's financial stability, customer reviews, and track record. Banks with a history of risky behavior or bad management decisions could be more vulnerable in a crisis. Sticking with well-established, highly rated institutions gives you a better chance of keeping your money safe. So when it comes to your savings, peace of mind is worth the effort. The bottom line, don't assume your money is automatically safe just because it's in a bank. Understand how the system works, diversify your savings, and take steps to protect yourself, because at the end of the day, the most important thing you can do is to take control of your own financial safety. Banks play a crucial role in the economy, but they aren't perfect, and the system they use comes with real risks. Understanding how fractional reserve banking works and how your money is actually being used gives you the power to make smarter decisions. By diversifying your savings, keeping an emergency fund, and exploring alternative assets, you're not just protecting your money, you're protecting your future. Remember, your financial security isn't just about trusting the system, it's about having a plan. The more you spread your savings and investments, the more prepared you're going to be if things take a turn. Stay informed, stay proactive, and don't wait for a crisis to start thinking about how safe your money really is. Take these steps now and you're going to be in a much stronger position no matter what happens. If you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, check out this video here. And also make sure to subscribe. Thank you so much for watching. I'll see you in the next one.